same mechanism, no interest payments. So no interest payments allowed every government who had basically, they'd all gone over 100% of GDP in debt. So all economic activity, all economic growth was used to paying of debts. So what they all did was basically restructure their debts between 3 and 5 years, creating an almost perfect 4-year cycle. And then when you look at the debts today, we're in that 4th year now where the final part, the larger part of the debt is due. And what we found is they start injecting liquidity over a period of 3 years, reaching maximum liquidity. That liquidity injection never really gets taken back. Some gets taken back in the bear market years when they're withdrawing liquidity, raising interest rates, trying to slow the economic cycle because of inflation or whatever. But over time, liquidity keeps rising. It's rising at a rate of about 8% a year. And that is, in fact, the debasement rate of fiat currency. And what happens is, and this is the bit that gets contentious with people and they hate it, if you divide an asset by the global liquidity, you get to see whether it's outperformed. The debasement.
People hate that chart.
Oh, they hate it. But it is the best chart in the world because it then tells you, okay, the declining growth from the population. So part of the magic formula was the debt growth and the other was the population growth. So they've used debt growth. This chart, nobody understands and it's never been copied on X, which is the bizarrest thing because it's the most incredible chart of all, which basically says that all government debt growth is basically a function of labor force participation rate. Now, what's interesting is then, okay, so the debts keep going up. We know the forward look of where the labor force participation rate is going to go, and how it's being funded is liquidity. And this is Fed net liquidity. You're probably better to use US total liquidity because that includes the private sector because they're now using the banking sector. So what they're doing basically is debasing currency to pay for the debt. It's as old as the hills. It's as old as the story of economies. It's as old as the story of money. And it's happening at a very pernicious rate of 8%. So you kind of notice it, but don't notice it. But what's happening is asset prices keep going up optically because the currency is getting debased. In emerging markets, FX, anything anymore. And I used to do all of it. I'm like, it's irrelevant if 97.5% of all of it is driven by one factor.
Yeah.
Never been in
I remember.
They rolled it every 4 or 5 years. They use yield curve control to financially repress, which is essentially currency debasement. Because they, at the time the dollar was pegged to gold. So it's the only way of doing it that way. And then what they did was wait for population growth. They're the baby boom, the largest in history, and productivity growth from technology. And what happened was GDP grew faster than debt, and over time, debt to GDP fell to a manageable level until the inflation of the 70s, driven by demographics, kicked in as everybody started getting into their 20s. And so we've seen that before. So this way around, our thought process, when we first said it, people thought we're insane, but I think it's becoming pretty obvious that AI and robots are replacement humans. And we're going to have infinite at some point. So the idea is, where does we have infinite? Because that breaks the whole GDP magic formula, right? Nothing makes sense anymore. We call that point the economic singularity. And we kind of finger in the air said, probably by about liquidity. So then everyone's working out the TGA versus the reverse repo.
Yeah.
And then they went, actually, it's total liquidity because we're going to stuff it into the banks. And now the next one is they're going to stuff it into stable coins. All they're doing is fine. I mean, that's Scott Bessement's job and Janet Yellen's job was the same. They're bond salesmen. They're just, they're masters of the universe bond salesmen, and their job is to find where to absorb this, and that is all part of the M2 growth.
I wanted to ask you guys about that because there has been that shift. You're right, where it feels like from basically 2010 to 2021 was this era where everybody got way too comfortable with this idea of QE and these traditional monetary debasement vectors, basically. And there's been this significant shift, and this is I've been thinking a lot about this, which is that QE in its form that we saw during
that quite surprised us. Gold is real-time financial conditions. Everyone's like, what drives gold? Suddenly we're like, we've seen this chart. Julien and I were like, something, and gold actually leads everything because it's actually current financial conditions, which kind of makes sense, right? It's the most sensitive to financial conditions. Then you've got the move in liquidity and markets, and the ISM kind of comes behind that. So there's this nice way that you can look at things to give you an understanding. So we all know, in fact, everybody on Twitter now knows that Global M2 leads crypto by 3 fucking months. That chart will be the death of us, as we know.
You guys have created a cult.
And it'll fall apart at some point as well, and then we'll be the worst people in the world, even though we try and tell people. So we've got financial conditions, then we've got M2, then we've got markets, ISM. So there's a nice kind of understanding of where this goes, which allows you to forecast stuff because, again, there's one dominant factor, which is so easy. I remember before having to figure is going to continue, and it has to continue. And the issue is right now is interest payments are at this level and GDP growth is still at this level. So there's not enough GDP growth to pay the interest payments. So the interest payments keep compounding, which is the thing that everybody picked up like Elon did, which is why Scott Bessent, everybody's screaming to get rates lower because it's causing a problem. You can see it in ISM. We've had this weird bifurcation where GDP growth's relatively high, whether that was the hangover from the immigration, the government spending, other stuff. But ISM, which is the guide to the business cycle, has been the longest ever level at 50 or below. So it's telling you that there's a big core part of the US economy that's just not functioning because rates are too damn high, because there's a crowding out from these interest payments, right? This is the actual issue that the Everything Code goes through. That has to get solved, if not the economy can't. And now it's just the liquidity cycle because the credit side of the equation can't go bust because they can't allow it. The system's too indebted to allow the collateral to go down because everything's over. That's all the people who say they should just let it all burn. They're like, you have no fucking clue what it means when the world is 400% of GDP in debt. Right? Yeah. What are you going to do? Write every single asset, everybody's savings down by 90% and say, okay, there you go. You got your reset.
The indices. And so you just, I don't think
also, this is an interesting thing is they're putting it in the SPY, right? Which doesn't give you any increase in purchasing power. So you're actually saving money in a vehicle. You're supposed to, an asset's supposed to be, you save an asset because you get more than compensated for holding that asset for a period of time. But you're not. Unless you own the NASDAQ or crypto, you just don't get that reward. So it's basically money in, money out. Yeah, it maintains your purchasing power, but it certainly as hell doesn't get you wealthier.
I will say the one exception to that idea of no recessions is if they try to balance the budget or any form of austerity. So that's why I started to get a little concerned in February, because that is the thesis breaker to me, is that if we go from a deficit of 7% to try to get it to 3% like they're talking about originally, that would be an issue, I think. But it's obvious that can happen. We've just seen this play out.
Yeah. And I think this was the final litmus test of it simply can't happen. Because balancing a budget, Australia, the US, the United Kingdom, and all of Europe in history as a percentage of population.
Yeah, last year we had, I think it was last year we had the largest annual increase in the US going back to since the records began in 1850, which partially offset the Everything Code, right? Because there was less liquidity required, which because offset that demographic pillar. So it was really, it's incredible.
And the point being is it was clearly agreed, the Everything Code has been agreed by all of the central banks and governments. They all clearly agreed, let's try immigration, because everyone knows the formula for GDP. They tried it, it backfired. So we don't have a choice. We're going into this world of technology, kind of Elon and other people have made it clear that this is the only way out. And the societal impacts on this are dwarf anything that we've ever gone through in history. Because we value ourselves and our jobs and our self-worth on the Uber driver who's next to you. Well, he's gone. The van driver, he's gone. The courier, he's gone. The delivery driver, he's gone. the postal worker, they're gone. It's like, oh my God, the restaurant server, the Starbucks person, gone. I mean, everything is gone.
Even the suits, those guys are gone.
Yeah, they thought they were safe.
Yeah, they're
Yeah,
gone.
that's right. Even the creatives,
Gone.
right? That was the last thing. And that's now not happening. So, the only thing we're going to have left is the ability to be human. And we'll reconfigure ourselves around that. Because, I mean, I don't know what value is at the end of all of this. This is why this economic singularity.
Like, subscribe, and turn on notifications. Support the channel by liking this video, subscribing, and enabling post notifications for more content on crypto and digital assets. Check out our other videos and share your thoughts in the comments below. Your engagement helps with the YouTube algorithm and keeps the content coming. Thanks for your support. Enjoy the video.